Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Spark Capital came out with a strategy note wherein they are saying that the investment cycle is on a cusp of a turnaround and that industrials offer value not in multiples, but in earnings, I presume earnings growth. Well, let's talk about this very bird's eye view that I've spoken about in detail with Ganeshram Jayaraman. I need an introduction. Joins us on the show. Ganeshram, good having you. Thanks for joining in. Um, I hope all is safe, of course, Ganeshram. And my primary question would be this, that at a point of time when the only certainty is uncertainty, why would you have so much of confidence around the return of the investment cycle? And are you confident of the timelines that you have in mind for this to be a full blown investment cycle, or are those a bit uncertain?
Morning, Neeraj. Always pleasure speaking to you. All well here. I hope the same with you too. Uh, I'll take you through my thoughts on why this big call for us, right? See, let's break this conversation into say three parts. Okay. First part is why should demand recover in the first place? Why should earnings growth recover? And why should managements get confidence to put up new capacities? Okay, that's the first important point because unless they see demand recovery, no management is going to plan for capacity expansion. Okay, that's an inherent important point. Then let's discuss what are the drivers for capex cycle. Okay, now if you look at the demand drivers, firstly, the most important point is the extent of money sitting on the sidelines. We had a brief chat on this the previous time as well, and things have actually further strengthened. If you look at fiscal 21, a pandemic impacted year where businesses have, there's so many fears of businesses having lost out and pay cuts and job cuts for retail consumers. But the balances in current accounts, which banks tell us, balances in savings accounts, which banks tell us, they have not just expanded during this period, they have actually materially jumped up vis-a-vis what it normally grows in any year. Now, where has this money come from? It's come from it's a multiplier effect of money which came from abroad. India has got about 100 odd billion dollars of foreign exchange inflows during this year in the form of lower imports, higher exports. IT is done okay. Pharma sector, agri, chemicals, they've grown. NRI remittances have held up. FDI flows have picked up. FPI flows have materially jumped. So it's all money into somebody's pockets. Is it into every Indian's pocket? Democratically, no. It's lopsided. Okay, but nevertheless, it's money which has come up, and that's kind of multiplying. So we are ending the pandemic hopefully with materially larger money in people's pocket, and today's savings is tomorrow's demand, tomorrow's consumption, or tomorrow's investments. And I get excited by the quantum of monies which are lying around. And to case in point, in the second half of last year, this did drive into demand, which we saw, say, from September festive season onwards, right till March. Demand drivers did indeed pick up. It's again slowed down in the second wave, but it did pick up in that period. The second important point is when I study banks' balance sheets, okay, the excess SLR they are sitting on more than regulatory mandated. There's always some element of excess which they hold, but the extent of what they own today as excess bonds, government bonds on the balance sheet, is 17 or close to 18 trillion rupees. It is unbelievable. I last saw in percentage terms about 11-12% sometime in 2003 when SLR requirements came down from 40% to 25%. And what that meant is banks had the muscle power to lend that money to retail. Till 2003, you might not know, banks could fund government's fiscal requirements and to lend to corporates. And they didn't have enough ammunition, or what I mean ammunition is the deposits, liquidity funding requirements to fund retail as well. This lesser SLR dramatically drove that. In the next few years, we saw an explosion of consumer demand, and NBFCs also sprung up. And what that meant was consumers who couldn't afford a house or a car or a bike or a consumer durable could start getting funding, and that drove the end demand for consumption, leverage consumption. So how I'm able to smell this money, this 17, 18 trillion, which is there, will it go to corporates? Will it go to retail? Again, like last 10 years has been. That's where one of them or both of them are going to get that money. So we need to be looking at where this money can go, which sectors, which subsectors, which could be the companies which will benefit, who will be the consumers who will end. And there our conclusion takes us to the next slide, next discussion part of our, which is on we think it has high probability of going into corporates.
Hmm.
And when I start looking at it, there are multiple points which are leading there. One is industry consolidation. Okay. Now, if you look at some 20, 25 sectors here, large sectors like say banks or cement or steel, and even smaller sectors like say cables and tiles or even pipes, the consolidation is actually one of the most important earnings growth drivers. What if demand recovery, industry consolidation, and inflation comes together, which we see now, which we have not seen for 20 years? These three coming together should lead to pricing power, and add operating leverage to it, because companies have cut costs and even if costs do go back next year, as a percentage of sales, it will be a lot lesser. And that means operating profit margins. And add deleveraging to it, it is pre-tax margins. Add the lower tax rate to it, it is post-tax margins or post-tax cash flows, which I'm looking at materially expanding. And
lower tax rate, sorry?
The impact of lower corporate tax rate, which got announced about 2 years back, we have not seen the full benefit of it. We have not seen the full benefit of lower tax rate on earnings, because initially it led to deferred tax liabilities going up, and that led to tax rates being higher. F20, the earnings got impacted. So the benefit of the lower tax rate has not yet been felt, and it has all gone into deleveraging. We think as deleveraging moderates, we think beginning next quarter or two, we think the chances are that this pool of cash flows starts seeking capital capacity expansion as it goes into 23. Because companies, if I look at say sectors in cement or steel to start with, the same thing is playing out, which is demand recovery. When you study their second half capacity utilization of the top 10 players in cement or top 4 private players in steel, their capacity utilization has reached the stage where they need to start planning for capacity expansion. Or if they don't do it, somebody else in the industry is going to do, and seeing the demand, and that is going to result in this consolidation, which is played out over 10 years, getting unwound again. And no management will want it to happen. So to protect their market shares, they have no choice but to do capacity expansion. And balance sheets allow them the luxury. They have deleveraged. And this is where I see. So when I look, taking the discussion to the capacity expansion side of things, and stop me if you have any questions, or you want me to pause a bit to discuss a little more on what we discussed. But if there aren't any, I'll just continue on where the drivers of capex cycles are coming.
No, please continue, Ganeshram. Let's just continue this thought.
So when I break, there are about 10 drivers where investment cycle we think will evolve. Okay. Firstly is the likely cash flows benefit on the lower tax rate, lower interest rate, the impact of the inflation on top line, and the likely cash flows, operating cash flows likely to be generated by, say, the 500 companies, the large 500 companies in India. When I look at it, we think it is going to be meaty enough in the next 2 years for it to start, for management to start asking, hey, what am I going to do with this pool? Either I do big buybacks, or I need to start planning for capacity expansion. And when I then put it in the context of demand, inflation, consolidation, operating leverage, and deleveraging, this construct makes us believe that it is very likely to start getting planned into capacity expansion. To further explain, the consolidated, it's not the industry-wide capacity utilization that you need to now see anymore, which is what we all used to see all these years. But now we are focusing on the top tier players. They have consolidated their market shares, and they are the ones who are going to drive the capacity expansion. And in the second half of last year, financial year, they went up to 85+% utilization. And in the past, whenever they've crossed 85% utilization, they've started planning for capacity expansion.
Which we've seen some of the industries do, right?
Steel. Already starting. Steel for sure. We think cement is also on the cusp. Refineries have all announced capacity expansion plans already. It's not even, I'm not even trying to tell you that it's going to come. It's already been announced. The state-owned refineries, oil marketing companies have announced capacity expansion plans. Ethanol blending requirements by fiscal 25 is going to make sugar companies, and one or two companies have already also announced capacity, which is going to happen. And then look at power. We don't see it coming in thermal power, but renewables for sure, where capacity expansion is going to happen. So steel, cement, renewables, and refinery, if you add power as a whole, these four sectors are typically 70% of India's capacity expansion. Right. And there I see driver in each of them.
Okay. So Ganeshram, since there is limited time that we have, let's try and figure out, let's work with the hypothesis that I'm not challenging you too much on this because your arguments are sound about why this should come about. And let's work with the hypothesis that the underlying demand overall, because of consumer spending, pent-up demand, what have you, comes back in order to support the thesis that you have for each of these major sectors. My question is, how do you therefore then go out and play this uptick of an investment cycle? And are there any risks to this argument, not from the corporate side, because the corporate balance sheet is delevered. They will probably smell opportunity. They will, in order, as you said, to keep market share, expand capacities. What if is there any risk to the demand coming back?
Yeah, I'll firstly take you through the second question I'll answer first. The key risk is what I started out with, which is the money which is there lying in bank accounts of corporates and individuals, right? That's actually the biggest opportunity, and that's where the biggest risk is. If money remains idle, if the scars of COVID are such that businesses say, hey, I've been scarred last 12 months, now I am going to keep 1 month's operating costs as cash balance, okay, liquid. Or if households say, I am not confident yet, I'm going to hoard cash. If everybody is going to hoard cash, okay, then, and which means consumption patterns come down, okay, then what I now told you is going to get pushed out. See, at the end of the day, this will get spent, but will it be a year later? That is the big question. That is actually the biggest question. The pool of, we are sitting on quantums of money which are unprecedented. Banks are parking 6-7 lakh crores every day in the reverse repo window. They are sitting on excess SLR of 17-18 lakh crores, and then households are sitting on, as I told you, a pile on excess. There is the savings and current accounts. The risk appetite is the key. The risk appetite is the key risk. Actually, will that change going forward? I don't know. Sure. So that is the biggest risk to all this thesis.
Which is a fair point. But you build a hypothesis that maybe it will come back and build
inevitable. I am looking at the inevitability of this. At the end of the day, social animals. People need to feel to want to go back to their previous lives. They want to vacation. Look at the demand already seen just a month after the second wave, what hotels and resorts are telling you, or what the flight data, travelers data is pointing towards. Okay.
I don't know, Ganeshram.
Went
I
up.
stepped out of my house. But
In
no.
that context, let's start talking how to, look at these stocks.
Yes.
I can't discuss stock names due to my compliance restrictions, but when I look at companies, I see it's one of the points that you said, right? Which is they appear 50 times EV EBITDA, 60 times earnings. Okay. On the face of it, I'm talking of the quality names within the industrials sectors, the engineering capital goods companies. But we think that's very misleading because these are companies whose earnings growth in the last 10 years, not just 1 2 years but 10 years, they have been 2 3% CAGR. Okay, their asset turns have halved. Their profit margins, if they were say 15%, then they are at 8% today. Okay, or maybe 10% at the most. Okay, uh, but their operating leverage has just gone out of the window due to this, right? So if you're operating at such low utilizations on your assets, the costs are there but the revenues aren't there. Okay, and that means the P&Ls, the income statements are not comparable. You need to normalize it. You need to normalize it for optimal asset turns, optimal margins. For that to happen, you need to go back to the first point I told you, which is, is there demand to take it to better asset turns? Will consolidation lead to pricing power and margins improve? Will inflation, if it's there on the commodity prices, which we all know on steel or copper or other commodities, will the companies be absorbing it, or will they be able to pass it on? Okay, will there be pricing power? We think the root cause, I go back to that first one, demand, consolidation, inflation, we think will lead to pricing power, and the industry consolidation should lead to, has led to fewer players to take that benefit away. And this is an important part in how we are seeing value in earnings. It's not value in multiples because they are not. A year back they were maybe attractive on multiples as well and earnings. It comes once in a few years. It doesn't come very often. Okay, but today what I notice is they are expensive on multiples, but they are misleading. If I normalize the EPS for asset turns and margins, the earnings are actually much more, and the multiples are much less. So it's not even on forecasted top line. I'm talking of potential top line and potential profit when the cycle plays out. So it needs to be seen with a different prism of lens, and to really see where these companies can be.
But you are building in some assumptions about a lot of the factors playing out for these forecasted, or rather, the probabilistic earnings to come back as well, right? The risk remains, but if the risk doesn't turn out to be true, then you believe that these are maybe a lot more reasonably priced companies than otherwise. Now, which is where my question is, Ganeshram. Would you bet, therefore, with a belief that the hypothesis will turn out to be true, would you believe that there is merit in owning the proven set of performers of the last cycle, even if optically they are very expensive, versus companies within those same themes, not necessarily proven through cycles, but available at a really cheap valuation? Because there are both, multiple ways to skin a cat.
Yeah.
What do you predict?
Really, for us, it's the companies with track record. Okay. Companies who have protected balance sheets during this downturn, who have done the capex. In spite of that, balance sheets are in healthy shape, and whose market shares have got strengthened during as others are weakened. So their income statements have been impacted, but market positioning within competition has strengthened. Balance sheet is strengthened, so they are ready today with the product suite, with capex done, with capability skills built in, to take that growth when the tide turns.
Okay.
So
Okay.
there are various buckets here. One is the industrial consumable space, where the bearings and abrasives and the companies who supply components. That's one way. Second is the capital goods manufacturers. And then you're looking at EPC contractors. Okay. Then you're looking at corporate banks. You are then looking at the global companies with presence in global markets who cater to demand not just to India but also in the export markets. There are indirect proxies in commercial vehicles, in logistics, or it could be the industrial cooling solutions or other capital goods companies. So when I'm looking at investment cycle, we look at companies across maybe 10 subsegments who are direct and indirect beneficiaries of this. And also keep in mind, when I talked about the capex cycle, also keep the PLI angle in mind. Okay, and the derived benefit from that. Keep the real estate also, it's the same. And and there are again cement companies. It could be the tiles or bathroom fittings or pipes or paints. That the real estate has its tentacles very widely spread across the economy. Okay, and then look at government's infrastructure spend on metros. There is a 150% jump which they've announced. And who will be those companies or subsegments who are likely to be part of that capex? Government has announced about a 300+%, 350% jump in spend on water. Okay, it's a
Yeah.
new evolving subject. We are all trying to understand. We see companies in pipe space who are beneficiaries, but we also need to understand better what that really means. Who are the companies in the listed space who could potentially benefit from government's infrastructure spend.
Got it.
So it's when you look at investment cycle, it's all of them. It's not just corporate capex. It's
Sure.
real estate, it's global, it's infrastructure spend, it's all of them. And then we have arrived at around 12 to 15 stocks which are direct and indirect beneficiaries of how this whole thing can play out in the next 3 years. Again, mind you, not everything is going to start next month when we open up better, because the scars are there. People will be on a wait and watch mode. Nobody wants to spend everything or be ready and then see a third wave or demand not revive, or balance sheets half if they've taken 10 years to rebuild it. No, don't want to lose it out in one, being too early. This will take time, but we think if our horizon is 3 years, which is how we look at stock picking, we think there is a very high possibility of this turning out into a rewards for us in this horizon. If the horizon is 3-6 months, I will not recommend any of these sectoral this theme at all.
Got it. Ganeshram, I have one final question on this conversation, and that is precisely at the point that you alluded to, the the massive quantum increases in spending that the government has announced of various sectors. Now, because of this stop-start nature of the economic cycle that we are in right now, could we run the risk of the government having overpromised and not being able to deliver, not for a fault of theirs? It's just that it's almost impossible even for the government to predict what the tax collections could be like, because this is not a normal cycle. Do we run that risk legitimately?
Definitely, we do run it. If as I said, if consumers and corporates are going to hoard cash in their bank accounts, that doesn't translate into GST collections,
So,
or it doesn't translate into income taxes or all the taxes which should logically come. So
no, sorry,
incentivizing.
sorry, I'll interrupt. But that's the simple answer. My other answer is: do you reckon that the government is biting more than it can chew? In that, yes, we'll expand the fisc deficit, but because there is PLI, because there is water, because there is ethanol, because there is Satat and the CBG program, and multiple others that I haven't even spoken about, have we, as a nation, uh, tried to spread ourselves too thin, or do you think all of these finances add up?
See, if globally every country is taking this, right? See, can you imagine? I mean, let's step back and imagine our fiscal deficits have, in percentage terms, are going to be two times what it was pre-COVID. Okay, but bond yields are well below what it was pre-COVID. Now, so if somebody had told me in January 2020 that India's fiscal deficit will be two times and bond yields will be 6%,
Would have
okay,
laughed.
you would have laughed at it, right? But that's what the world has become post-COVID, and it's not just in India phenomena. It's there. All what I told you is a global phenomenon. It's happening in every country that you are seeing coming out of the COVID. The destruction in economic activities or due to and lives. I relate it to how we reacted post World War II. This is when the coming out of the World War II, the worlds did the same thing, and that was 70 years back, and wisdom was so much there without as much information as we all have today. That the reactionary was spend it on infra. It was fiscal, which is the heavy, does the heavy lifting initially. Liquidity is so surplus in the system. It was there the case then too. Inflation did rise, metal prices did go up the same way, but you have no choice but to react out of a challenge like this. The first bit of heavy lifting has to be done by the government, and every government is doing this globally. You see what Biden's spending patterns are all about. It's about fiscal coming out of the financial crisis 12 years back. uh, Central banks drove the agenda, and they put money into markets' hands, and half the bonds in the world went into negative trajectory, and multiples went up, equity multiples, but earnings didn't grow, and inflation remained low. Real inflation. I'm talking about real economy inflation. Okay. Markets saw inflation, but real economy didn't see inflation. Now, coming out of the COVID, we think the agenda narrative will be led by governments on fiscal spend with support from central banks, of course, but it will be led by them, and that means the real economy is going to see inflation.
Got it. Okay. Ganeshram, one final question. Would you reckon, I mean, since you drew parallels, uh, uh, and I just want to focus a bit on something that is not probably a part of your report, but maybe indirectly is, and that's commodities and commodity prices, etc. In some cases, some people believe they have run quite a lot, and therefore there'll be consolidation stroke correction because they are global in nature. Metals, for example. What's your view there? And what's your view? What's the house view on agri commodities?
See, we don't cover too many commodities, so it's not a firm, clear view that we do have, but we do see supply disruptions getting normalized in the next few quarters or months, and that should lead to some normalization on commodity prices. But if you take beyond this normalization phase, given what I told you on the fiscal-led revival, we need to see commodity prices on the uptrend. In the short term, there could be a normalization due to supply disruptions getting readdressed. But we think these are after 10 years. Keep in mind, we have the be it oil or metals. There have been very little supply coming. We didn't add too many capacities. But now, when demand revives without supply, just not looking at disruptions in the short term on shipping and others, but I'm saying beyond this, prices have to hedge up.
That's true. Okay. Very cool. Ganeshram, this was lovely. And viewers, I urge you, if you get a chance to read this report, it is a wonderful note. So do try and read it. We'll, of course, reproduce this conversation in the form of a story a bit later on as well. But thanks so much, Ganeshram, for joining in today, and stay safe.
Thanks. Pleasure always speaking to you.
Likewise. And viewers, thanks for tuning in to this edition of The Talking Point.